the reality is where the debt is right now, where the interest rates are right now, the government just cannot continue on this path. So that's why Ray Dalio is saying this is going to happen. We have to be prepared because there's really no other option. We're kind of stuck in this boat now, and this is the only option they have to go ahead and get out of the debt situation. So he's saying, there's the forewarning. Understand how this works so you can be on the right side of this token. Because if you're on the wrong side, if you're just a saver, taking your $300,000-$400,000 a year, saving as much as you can in a bank account, the reality is the government is purposely devaluing that money, and it is losing purchasing power every day that it sits there.
Billionaire Ray Dalio, one of the world's top investors, believes the enormous U.S. debt is set to depreciate, which might actually benefit consumers. But what does depreciating debt actually mean, and how does it impact you as a physician? In today's episode, we'll break down Dalio's insights into simple terms, explaining how understanding these economic shifts can help you better manage your investments and make smarter financial decisions for your family. I'm Nate Crannell, joined as always by Mike Neubauer. Together, we've built Grand Vision Capital and Grand Vision Family Office, acquiring multiple millions of dollars of real estate each year and helping physician families around the country turn their six-figure incomes into eight-figure net worths. So, Mike, this is something that we talk about all the time. There's an online article that has a bunch of fancy language in it that people outside the financial world might not quite understand. So in this article with Ray Dalio, what does he mean by depreciating debt?
Yeah, so you're telling me that everybody hanging around the coffee in the morning, they're not having these conversations about the U.S. and depreciating debt and what that all means, huh? So the depreciating debt, at the end of the day is a fancy way of saying that we have so much debt and that debt is going to lose value. And the way that debt loses value is via inflation. So that debt, let's say $1 trillion, the value of that $1 trillion over time will be less. So the fact that you have $1 trillion in debt, and even if you're earning interest on it, you're just not going to keep up with inflation. So you're going to lose more purchasing power over time that your investment will not keep up with. But what he's talking about specifically is on the debt side. So this would be the bond market. This would be borrowing and lending. So this would be banks, bonds, things like that is where he's talking about. And of course, this all ties back to the central bank, and in our case, the Federal Reserve, which makes the decisions on interest rates. And that decision is really what is going to have a big impact on what he believes to be depreciating debt.
That makes sense. And just this past week, the central bank did reduce interest rates or the Fed rate down by 0.5% or 50 basis points. So now I believe we're at 4.75 to 5%. What does this mean from a lending side for banks now that the Federal Reserve has set this rate, this new rate here in September 2024? What does that mean for banks as they're lending? What does that mean for consumers as they're borrowing?
So basically what we are saying here is they dropped the rate, but they're basing this on saying that the inflation, and we'll call it CPI, they're saying it's getting close to the 2% mark. What Ray Dalio and many other investors are saying that are out there is that that's just not an accurate representation of inflation, that they believe lowering that rate is going to cause inflation to rise at a quicker rate. So they believe that even if somebody borrows money at 5%, inflation will outpace that. So receiving that 5% back on a loan that maybe the bank will give, that bank is still losing purchasing power. They're still actually losing money theoretically over time because the cost of inflation is making that worth less money down the road. So what he's basically, what we're kind of talking about here from the consumer level is more on the investment side. So we're not talking about buying your principal residence. We're not talking about going and buying a car. The reality is that these conversations do apply to that, but anytime really that you're not borrowing money to make an investment, it's really not an investment of any sort. It's not a valuable decision no matter what. So this is kind of pointless unless you're actually borrowing money for investment purposes. If you're borrowing money to buy a car, you're borrowing money to buy your first home, all you really care about is what interest rate you're locking in to lower that payment. But when you're borrowing money to go make an investment somewhere, you care about that side of the token of, am I borrowing low enough that I'm going to make enough money? And if I'm lending on anything, am I going to make enough on the interest side of things in order to actually outpace inflation? So this is all just about investment side of things, not the consumer side of things where you're borrowing to buy a new TV or a car or whatever the case may be.
Yeah. For banks, though, and this is something I thought about when I read the article, is, the Federal Reserve sets the rate. Banks then typically lend 1.5%, 2% higher, and they collect that margin. That's the bank's income. What does that mean for the strength of the lending power for banks, knowing that inflation may be above what they're lending to the consumer at?
Yeah, so in a perfect free open market situation, most likely the bank would not make that loan if they believe that their interest is going to perform worse than inflation. Because really, at the end of the day, they're losing value and purchasing power over time. But the reason banks will still lend, and the dilemma that we're stuck in now within this world, is that the interest rates are going lower on the Federal Reserve side. So the banks are expected, everybody that sees that article, we expect to pay lower rates when we go to the bank now. So that is the desire of everybody walking into the bank. So the bank is kind of feeling that pressure to push rates down when these big stories come out. So really, if this was only the bank's money and they were taking their money and just putting it out there as an investment and making the loan, it just wouldn't be profitable enough for them to do so. They would either have to tack on a lot of fees, or that margin has to spread so greatly to outpace inflation. So two things you're going to see now in order for this to work, because a bank only makes money if they can lend it out. They have to be able to lend money. That's their purpose and how they make money. So the way it works is interest rates on a savings account are going to have to go lower. So that's a way that they can take your money and pay you a lower interest rate and access a lower cost of capital in order to go reinvest it and lend it to somebody else. So that's most likely what you'll see is interest rates, even on these high yield savings account, will keep pushing down because the banks just cannot offer as much and still lend at that normal spread because they're just not making enough money at that point. The other thing, and this is the big kind of elephant in the room when you talk about the national debt and how will it affect us, is the Fed and the government is really going to be that backstop to the rates. So they're known as kind of the risk-free rate is the U.S. bonds that can be issued, and they backstop the banks. So when the bank now is going to go make a loan to somebody, it's really not their money, because if it was, they would not be making that loan. So what they do is borrow in a way from the Fed at, let's say, that 5% rate. It's 4.7 to 5 right now. They're going to borrow there and then go ahead and lend it to us. So they're borrowing at an artificially low rate and then lending it up to us at a higher rate. So they're not as concerned now about that inflation versus the interest rate, because they're making their money based on that spread of them going and borrowing money first at an artificially low rate and then lending it back out into the market. And this is that fine line that they're trying to walk right now, because the market wants lower rates. The government does not want to harm the economy. So they have to kind of push rates lower in order to stabilize employment, stabilize the economy, but they're also going to cause inflation. So they're stuck in this catch-22 now, where the normal economic factors are not going to make sense going forward. And really, it's only because the government is willing to step in and be this backstop that the market and the economy is going to keep growing. And that's a concern, is that backstop comes via increasing the national debt.
Great point. That's a great insight. I think that was a great way to break down really the complexities of what's going on behind the scenes. Most average consumers just hear, hey, the Fed is dropping the interest. A lot of people don't know what the Fed is, but like they hear, the Fed has dropped interest rates, so I should be able to walk into a bank and get a loan that's, 0.5% less than what it used to be, which generates buying power, or generates interest in buying, correct? So as we think about physicians listening to this, how does, the Fed dropping the lending rate, how does Ray Dalio's thought on this debt, how does this impact in a positive way, I think, the buying power of physicians who are wanting to go out and borrow money?
So on the buying power side, it's really on the investment power side. Like we talked about, the consumer side it's always going to be difficult. Is it valuable to understand where interest rates are going? And if you have low interest rates, especially if you have a house that is at a higher interest rate and rates come down, you want to lock that in for 30 years. We have a lot of benefits being in America that we can lock in long-term rates. But outside of buying your principal residence, as far as purchasing power, these rates and these shifts just really don't have a huge impact on the everyday American. Unless you're the person who buys a car every 2 years, trades it in, you keep rolling over that debt, but that's not really our listener. The people that we're talking to, they're not in those types of boats. So the one thing that the physician needs to be looking for now on the investment side of things is this is likely to be best for the borrower and not best for the lender. Unless you have a direct connection to the Fed and you have a way to access those artificially low rates, then it's going to be great to be a lender. But if you are just a regular investor, like all of us are, you want to be on the borrowing side, not the lending side. So what does that mean? You don't want to own a lot of bonds, for instance. So it used to be the old adage would say, we're going to go with stocks, heavy equities early in our career. And as we get to the end of our career, we're going to start changing that to a bond portfolio. But when you own bonds, you own debt. You are now the lender. And what Ray Dalio is saying is that that debt is going to be depreciating. It's going to start losing value. So it's really not a less risky investment because it's going to lose value over time. And if you think you're going to retire at, say, 60 and switch to a bond market, and Ray Dalio says for the next 20 years, debt's going to continue to lose value, well, that's not really the place you want to be. Where you want to be is on the borrowing side. So for us, we do real estate. And that is really kind of going to be the huge opportunity, is to lock in assets, especially if you can lock them in with long-term debt at low interest rates, because now you're on the borrowing side. And the thought behind what Ray Dalio is saying is, if you can lock in an interest rate today, let's say you can lock it in at 6.5%. It'll probably even go lower, over the next few sessions. It'll probably drop a little bit more, but who knows? But let's say you lock it in at 6.5% and inflation starts kind of taking off, and now values are rising and the asset values of properties are going to be similar to inflation. It's not exact, but they're going to rise, let's say, at 8%. Well, over time, you're making 1.5% more every year because you have this locked in 6.5%, and then you have an asset that is growing at 8%. And that's basically what everybody's talking about right now, is kind of a low rate environment. And inflation is kind of taking off, and there's no room for the Fed to raise rates without harming the economy. And that's really what everybody's talking about. And in that scenario, when you borrow money and own good assets, when that inflation takes off, those values will climb very quickly, but you have a locked in loan down here at a lower rate than what your value is increasing. I am super excited to introduce to you the Doctors and Dollars 5-Day Financial Challenge. I'm Mike Neubauer, I'm CEO of Grand Vision Companies, and I'm the one that you see on the Wealth Wednesday and Daily Dollar episodes with Nate. So Nate and I are partnering again to do something even more exciting, which is the 5-Day Challenge. We're taking the best of all of our episodes, all of our expertise and knowledge, and we're condensing it into an impactful and purposeful 5-day presentation, 1 hour per day, for 5 days, to give you everything you need to build that foundation for your financial future. So if you're looking to gain the pieces, you want those puzzle pieces and find out how they fit in your financial plan, head over to the Doctors and Dollars website, join us on the 5-day challenge. We're putting it together for free, so you got nothing to lose. We look forward to seeing you on the inside.
Gotcha. So what I'm hearing you say is, for a physician who's going out to buy a new house, yes, interest rates will drop a little bit than they were a few months ago. But this article and what Dalio is talking about is not necessarily as attractive in that space. What's attractive now is borrowing money to go out to invest, right? So maybe this is the time when you would want to borrow money for investment opportunities. What does those types of things look like for physicians?
Yeah, and even on your personal residence, that will be a value, because the thought behind it is that prices will rise on real estate. The difference is when it's your personal home, it's hard to really make it an investment, because the only way to capitalize on that investment is to sell it.
It's to sell.
And then when you sell, you have to enter the market at this new higher rate. So it's very difficult to ever manage that perfectly to make it actually be a valuable investment. So now would be a time to lock in, for instance, we talked about the real estate, anything real estate related. If you can lock in a property, you want to buy rental properties, you want to buy apartments, storage facility, anything that really has real estate as the main asset, and you can have a loan against that to lock you in. And then that asset, you just manage it and let that value rise. And then as rents rise, the value rises, and hopefully that outpaces what your current interest rate is. So that's a great one. The other one that's obviously very common is always going to be on the business side. So things like SBA loans and different business loans, wherever you can lock in lower rates today, the thought is that inflation will rise. So let's just say even a contractor, let's say an excavator is an easy example. If you can lock in machinery equipment on a lower rate today, the inflation is going to drive the cost of jobs up higher over time. So you're going to lock in a low rate today based on what you can charge. But next year and the year following and 10 years from now, because of inflation, you'll be able to charge so much more money to complete that work, but you'll still have this locked in loan payment on that machine. So you have a locked in low rate, but the rates on your income and what you charge customers just keeps rising. So on the private business side of things, that's what you're looking for, is where can I lock in an interest rate that gets me what I need today in order to keep growing this business? Because as this business grows, the cost that I can charge, or the price that I can charge in the future, is going to rise very quickly with inflation.
Yeah, no, that's good insight, and that's for anybody listening. That's something that probably comes across their desk every now and then. As they're thinking about their own business or peers' business, things like that, or investment opportunities that come up. As physicians are always looking for different strategies to diversify and build their wealth. This is a really good time to do that, just based on the current debt structure that we have.
One more thing I'll give you about the physicians. If somebody doesn't want to be active, they just want to be passive. The same thing, we talked about the bond market. Well, on the flip side, if you're investing with somebody who is in real estate or private business, or even if you're considering just a basic bond versus stock portfolio, inflation in depreciating debt is going to benefit the equity side. It's going to benefit the stocks. And granted, you may not increase your purchasing power a ton, but likely the stock market will rise with inflation, because when you're investing in a company, you are basically investing in what you hope is a very well-run company, and their top people, their CEOs, are going to be looking at these opportunities and saying, how do we get on the borrowing side? How do we lock in low rates as inflation goes? So when they can do that, and you're just a shareholder via the stock side of things, you're going to find the gains and the benefits of that inflation rising and that company having a locked in low rate. So same thing, you just would want to very much consider, where am I investing right now? Is it in bonds or stocks? And if these people are right, if debt is going to depreciate and inflation is likely to rise quicker than expected, that leads people to believe that the stock market will outperform the bond market quite a bit.
Quite often. Yeah, for sure. What does he mean? One thing that Dalio mentioned was he sees a path forward toward monetizing debt, which he related or correlated to how Japan is currently handling their market, which, if anyone knows anything about the Japanese markets, they've ridden negative interest rates for a little bit of time. What does it mean to monetize debt?
So in general, what Dalio is referring to is really what everybody calls money printing. So we picture the old school way of a printer sending dollar bills through and sending it out into the economy. But what Dalio is talking about is actually how money printing works, and monetizing that debt is when the government, the US government, and technically the Fed, the central bank, they're supposed to be separate, right? We've talked about this before. But when the US is saying we need more money to either cover our current interest payments, to run our operations, whatever we need, the central bank steps in to buy that debt from them. They give them the money, and then they hold that note and say, pay us back when you can at these interest rates. So when the Fed steps in and buys all the time at these rates, it forces those rates to stay artificially low. But really what they are doing is the Fed is just injecting money into the US economy. They're really just printing money is what it boils down to. And the downside, and what Dalio is talking about, and this is why we're talking about inflation taking off, is because it's not quite the same idea as inflation, but when you print money, when there's more supply of money in the world, it creates less value. So when the central bank and the Fed, they go ahead and buy these bonds and send that money to the government, that money makes its way out into the economy. Well, now there's so much more money in the economy, the actual buying power of your money is reduced. The US dollar falls in value. There's different ways to track the value of the US dollar, but the US dollar is actually losing its purchasing power because they're just printing money. Just like anything, if something is very exclusive, it's going to be high cost. But if it's just free to everybody, the air that we breathe, it loses its value in that time as far as that it costs no money. So the more money that they print, the more our money loses value. And that's why Ray Dalio is talking about the monetizing and talking about how if you save money and the government is devaluing your money, you're really losing money at the same time. The only way to overcome that is to invest in things that are going to outpace the downfalls and the consequences of monetizing this debt. And the reality is, where the debt is right now, where the interest rates are right now, the government just cannot continue on this path. So that's why Ray Dalio is saying this is going to happen. We have to be prepared because there's really no other option. We're kind of stuck in this boat now, and this is the only option they have to go ahead and get out of the debt situation. So he's saying there's the forewarning. Understand how this works so you can be on the right side of this token. Because if you're on the wrong side, if you're just a saver, taking your $300,000-$400,000 a year, saving as much as you can in a bank account, the reality is the government is purposely devaluing that money, and it is losing purchasing power every day that it sits there.
Yeah, that's a great insight and a reason to understand that the investing power versus the saving power, and why investing those dollars and getting them put to work for you, while there is some associated risk with that, and a lot of people who are more conservative will say, like, man, I just don't want to take on some of that risk by investing my money out there. The upside, though, is that you're going to outpace inflation versus simply putting your money into a savings account. And to your point, I mean, Dalio even says, like, the intervention of the Fed coming in and essentially printing more money, like you said, that's a significantly bad event. And people will see that and they're like, oh my gosh, the Fed is terrible and can't believe they're doing this, but they're doing it for a reason to honestly save it, right? They're coming in and saying, I have to do it. Otherwise, the value of this dollar goes haywire. The debt ceiling becomes limitless, and things all go downhill. So
when your back's against the wall, you got to do something. That's kind of what Dalio is pointing out, is they're out of options. Their back's against the wall, and he's not saying this is good, bad. He's just saying there is no other option. So be prepared.
Yeah, be prepared. Put your money where it's going to be most advantageous to you, and that's not in a savings account. That's not in the bond market, but it's truly investing and becoming a borrower at this point in time. I want to go into final thoughts, but with final thoughts also, like, how long do you foresee this type of economic environment where we do have this debt management essentially that we're talking about? How long do you foresee this happening, and what is kind of on the other side of this?
Yeah, so final thoughts, and remind me if I forget that specific question then, because that's kind of a deep question. But the one thing I want to touch on then with final thoughts is you talked about investing and saving, and people are preached to save their money. But the thing that they don't understand is they just don't have the financial understanding and knowledge of how our financial system is now built. So if you take your grandparents' investment advice and you save, there may have been value and benefits in saving back in the day. And especially when we were on a gold standard, there was way more value to saving your money. But coming off of the gold standard and basically giving the government free rein to print money, it wiped away the benefits of saving. It has totally removed any benefit and actually made it a loss to save money, because we're just in a new financial system now. And that's what people don't realize, is this new financial system, although it's not new for you and I, we were born into it, but it's not generations old. It's still just a little bit old, where we still have our grandparents that give advice to save because that was the right advice at that time. We still have parents who believe very much in saving because same thing, they were raised in that environment and that was good advice at the time. The problem is they missed the realization that now with a money printer, saving doesn't work the way that it did. The other thing I want to bring up is, we've talked about this before, because right now it's presidential election time. Everybody has a tax plan. We're going to do this for taxes. We're going to do that. Raise taxes, lower taxes, tax these people. The truth is, nobody wants to raise taxes. It is hard to raise taxes and win an election in the following cycle. So even if they say they're going to raise taxes, they're going to look very carefully to make sure that raising taxes guarantees a win in the future. If they look and say, man, raising these taxes is likely to cost us votes, they're just not going to raise taxes. So what do they do instead? It's just a secretive tax raise. So if you earn $100 and I say, give me 20% as a tax, now you only have 80. That hurts. And I say, I don't want to pay taxes. That hurts. But if you don't understand the financial system at all, and I give you $100,000 and you get to keep your $100,000, but I devalue that money by printing money so you can only really buy $80 worth of goods, I taxed you exactly the same at 20%, but it was so secretive that you didn't even see it, and you'll still vote for me on the next election because I didn't actually knock on the door and ask for you to give me that money. I just ran my printing press and did it in a way that only Ray Dalio and investors understand anyways. So I'm still able to tax you without losing votes. And that's why everybody runs on these elections and they preach all these different things. But the way they're going to do it is much different. It's going to be in a way that doesn't upset the apple cart. And it's going to be just in a way that the insiders understand and know what's coming. And that's why it's important, these things like Ray Dalio, to listen to what somebody like this says, because he is going to be at the forefront of this. And if you can copy that, you can come out ahead and benefit from this and benefit from the fact that the rest of America doesn't understand it. They're going to do this because they have to, and because the rest of America doesn't understand it. So if you understand it, you're going to be on Ray Dalio's side. You're going to be on the winning side of this equation, because the only other way for them to get out of this mess is just raise taxes through the roof to make more income. But nobody's gonna do that. That's not an option. So that's why this is the only option. You have to understand how this works in order to be on the winning side.
Yeah, that's definitely an interesting perspective that people wouldn't think about. They just hear the word taxes, they hear presidential nominations and what their policies are, and they go for which one has a minimal impact to their bottom dollar, right? Not realizing that honestly they could do it in the same way. It's just kind of, behind the curtain. We're just going to devalue the dollar by 20% versus tax you by 20%. In the end, it comes out the same.
And in the end, even right now, both candidates, in the end, will probably have a very similar approach to the economy when it's there, because like Ray Dalio brought up, their back's against the wall. You really don't have a lot of options. So it doesn't matter if you're Democrat or Republican. If you only have one option, you're going to have to use that option no matter what side of the fence you're on.
For sure. Yeah. Did you want to touch on my question, deep question that I have?
Yeah, remind me of that.
My deep question was, how long do you see this current environment when we're talking about debt management and Dalio's article? How long do you see this happening, and what's on the other side?
Man, that's very tough to know. You have things like cryptocurrency and Bitcoin, which honestly, it's just too new for me. Some people are all in, some people are all against it. It's just too new to really know how that will play in the future. I don't see that being a huge part of the future, simply because the benefits of it is that it's not manipulated and regulated. And that's what everybody says are the benefits. I think the government really likes things that are able to be manipulated and regulated. I think they have more control, and they're going to do things that gives them more control, not less control. That's the only reason that I think that's going to be tough. But as far as how long this will last, the elections and what team gets in there, they're always looking to win the next election. So that always throws a wrench, because it's not just simply what is best for the economy, how do we get out of this situation, where do we stop? It's all about winning an election. So these decisions are made in order to band-aid problems and avoid collapse on your watch. You're hoping that nothing happens when you're in office, and then if it does happen while you're not in office, you can swoop in on the upside and be the savior of the day. So that's why it's very difficult to know, because both sides are kind of rooting for the other to screw it up, right? But at the end of the day, this is very new. Like we said, the financial system that we have of money printing is fairly new. It's only a few decades old. Japan has gone through about 20 years of a similar cycle. So we do have some history that people are watching. They were able to somewhat stabilize it. But a lot of this is new economic theory. A lot of this is, like we talked about, you're down to the last bullet in the gun. And if you're down to the last bullet, we haven't seen what happens when you pull the trigger on that last bullet yet. So everybody's going to do the best they can to stabilize this. What I think personally, I think that inflation is going to take off in the way that I believe that the value of the dollar will collapse tremendously. So we've seen it already. What costs $100 today, it only costs, $60 not too long ago. My wife orders on Instacart for the groceries. You can save an order. And it's like, you look at a past order, that exact same order costs $160 and now it's $300. That's just the devalue of that dollar. All it means is I now need $300 to buy $160 worth of goods. And I think that trend will continue. I think it's a very secretive way that people don't realize that's happening. I think people are very comfortable with credit. So when they get pinched by the devalue, when groceries seem so much more expensive than what they used to be, credit card balances grow. And I think people become very comfortable using credit in those ways. So I think that's our biggest risk, is that just like the government, people start overusing credit and get stuck in a bad situation to try to keep up a lifestyle that they cannot keep up anymore. But it's always a give and take of, do wages keep up at the same rate as the dollar loses its value? As inflation climbs, do my wages keep up, the cost of living increases with that increase? And that's really where the balancing act is trying to keep those wages in line. So as we inflate the dollars away, we don't crush the American families by just making it too expensive for them to live.
Absolutely. Beautiful insights you provided. Really enjoyed today's conversation. I think you did a great job of taking what is a very complicated topic and simplifying it down for people to understand, but also giving some good steps on what's the right position to be in, moving forward based on what our economic environment looks like, after the Fed lowered the rate. So nice work, Mike. We will be back at it again soon.
All right, man. We'll see you on the next one.